Well, it's just gone 9 o'clock. Good morning, everyone, and welcome to the Spring Budget Review with Azets, held in partnership with the Greater Birmingham Chambers of Commerce. I'm Raj Kandola, Head of Policy at the Chamber. I'd like to welcome you to this morning's event. Next slide, please, Grace. So a bit of background into the structure today. We know, obviously, the Chancellor painted a somewhat sober picture of the nation's finances on Wednesday. But what implication does that have for tax, and what does that mean for the businesses that will be affected by some of these changes in the future? Well, with me today to discuss this very important topic and others, I'm delighted that we're joined by Claire Clifford, who's Head of Tax in the Midlands, Rebecca Colmy, Tax Director, and Benjamin Barnett, Senior Tax Manager, who will each run through their presentations in due course. In terms of structure today, I'll quickly touch upon our Keep Business Moving campaign and a couple of upcoming events that might be of interest as well. We'll then hand over to the team at Azets to run through their presentations. And then at the end, we'll have a bit of time for Q&A. So if you've got any specific questions that you'd like to raise, please do either leave them in the chat box or use the Q&A function. And we should be aimed to finish at 10. And yeah, good to go from there. Next slide, please. So very quickly, for those of you not familiar with it, the Chamber has been running the Keep Business Moving campaign throughout the pandemic. And I think in essence, it reflects the very nature of the Chamber itself, in that we've been there to help businesses connect, support and grow through this very difficult time period. So from a connect perspective, we've been running our hashtag GB Chamber Chat every weekday between 11 and 12 on Twitter. We're still running our member-to-member offers as well, so raising awareness of different products and services, which is still going on. In terms of support, we've got our COVID-19 hub, which sets out the various support measures which have been introduced by government to help businesses get through this difficult time period and how you can access them. We're running a number of informative webinars such as these as well, and we still have our free legal and HR helpline, which members can access the service via their relationship manager. A big part of our work is obviously around lobbying and campaigning, so gathering feedback from the business community and using that to inform policy at local and national level. And of course, from a grow perspective, we're still after thought leadership content. So if there's blog posts or videos that you'd like us to share during this time period, do let us know. And of course, we still have our daily e-news articles, which go out to over 14,000 subscribers. Next slide, please. Now, a couple of things I wanted to make you aware of before I hand over to the team at Azets. We are currently surveying for our quarterly business report. Essentially, this is a health check on the regional economy. It's been running for 30 years. We go out to businesses and ask them a set of questions around export demand, domestic demand, but also any concerns they might be facing. And we use that information and share it with the British Chambers of Commerce, who share it with the Bank of England and Treasury as well. So really, really important tools to gather information, helps obviously inform our lobbying output as well. So if you haven't had the chance to fill that in, then please do so. I'm sure Grace or Charles, my colleagues, can include a link in the chat box during the session. And another event that I wanted to make you aware of that we're hosting next week is an event with the West Midlands Mayor, Andy Street, where he'll look back on his tenure as Mayor for the last 4 years, but also look forward to some of the challenges and opportunities on the horizon for the region as we emerge from the coronavirus crisis. So again, that's taking place next Thursday between 1 p.m. and 2 p.m. And again, we can share details in the chat box, or details can be found on the website itself. Next slide, please. And that's it from me. So I will now hand over to Claire. Claire, over to you.
Okay, thank you very much, Raj. Just bring up the slides. Hopefully you can see those now. So good morning, everyone. I'm Claire Clifford. I head up the tax team at Azets, and I'm delighted to be presenting to you today with my colleagues Rebecca and Ben. So after a long-awaited budget this year, with lots of speculation about tax increases and what we might be looking to do as a country to repay some of those borrowings that we've had to make over the last 12 months, the Chancellor Rishi stood up on Wednesday and presented a budget all about investment, all about the recovery in the UK, supporting businesses to get back up and running, fixing some of the financial crisis and what he plans to do about that over the next couple of years, but really just to support businesses, support employees, the offer of many more grants to the non-essential retail, hospitality and leisure industry, and extra loans and business rates holidays. So over the next 40 minutes or so, we're going to go through some of those main issues. The agenda today, firstly, Rebecca will be covering some of the issues affecting companies. I'll then come back in and talk about some of the general business matters that were announced affecting all businesses. And we'll finish off with Ben looking at some of those individual changes and changes that are proposed to tax administration and the penalty regime. So first of all, I'd like to introduce you to Rebecca.
Good morning, everyone. I'm going to cover the corporate issues like Claire said. So we're going to start with a positive first, possibly one of the only things that wasn't leaked in advance. The introduction of what the Chancellor referred to as a super deduction, an incentive to invest in new plant and machinery and receive a deduction from profits of 130% of the expenditure. The super deduction is actually one of two new allowances introduced into the capital allowance legislation, both of which are only available to companies, but they sit alongside the annual investment allowance that is also available for unincorporated businesses. The two new reliefs are only available for expenditure on new, previously unused plant and machinery in the period from 1st of April 2021 to 31st of March 2023. For items that would normally fall within the main pool, for example, lorries and machinery, the super deduction will be available at 130% of the expenditure incurred. And for items that would normally fall within the special rate pool, such as integral features and long life assets, the special rate allowance of 50% of the expenditure incurred will be available. Points to note with this new allowance is there are specific counteraction measures in the legislation for contrived arrangements. Special adjustments may be made to balancing allowances when you sell your super deduction items on. Items which are already purchased under unconditional contracts won't qualify. And it is actually quite complex legislation. It's the only part of the budget where little bits of the legislation have already been shown, and it is exceptionally complex. So it's something to talk to your tax advisor about before you actually invest. So let's look at some examples to see how this could work. If a company spends 100,000 on plant and machinery after 1st of April 2021, they'll receive a deduction from profits of 130,000, saving corporation tax of £24,700. Whereas previously, if they had claimed the annual investment allowance, the deduction would have only been 100,000, CT saving of 19,000. So that's an extra benefit in cash to the company of 5,700. Please remember these new allowances have no limits. They sit alongside the annual investment allowance. So if you've got expenditure on different types of assets, machine, integral features, you could claim the 130% allowance on the machine and then consider claiming actually the 100% AIA on the integral features rather than the 50% special rate deduction. So after that positive news, let's move to the bad news, CT rates. I think we're all expecting a slight increase in corporation tax rates, but not the news of a move to 25% main rate. Now, there will be a delay. For the next 2 financial years, the rate is expected to remain at 19%. But then from 1st of April 2023, we'll return to a corporation tax charging system similar to what we had in years prior to 2015. We're going to have a main rate and a small companies rate. Companies with profits above the upper threshold of 250,000 will pay corporation tax at the main rate of 25%. And companies with profits below the lower limit of 50,000 will pay corporation tax at 19%. And for those companies whose profits fall between these limits, or they'll pay at the main rate with a deduction for marginal rate relief. The main difference from the old pre-2015 system is that the limits are substantially lower. So we're going to have more companies paying tax at the main rate. Points to note with this are, if your company is what is termed a close investment company, that's essentially a company that isn't trading or a company that isn't letting property commercially, then your company will pay tax at the main rate always, despite the level of profits. Second point to note is if your accounting period is less than 12 months, or if your company has associated companies, the limits will be reduced. So in practical terms, what will this mean? Companies will be looking at how to reduce their profits. They may prefer not to continue rewarding working shareholders totally with dividends. They may look at packages that include company pension contributions and a salary. They may be looking to see if they can make investments and take advantage of the attractive new capital allowances or the research and development deductions. So we've already looked at the two new forms of capital allowances that are going to be available. In a minute, I'm going to look at research and development, but let's first consider what deductions you could get on company vehicles. Enhanced capital allowances are available for companies who purchase electric or hybrid cars where the emissions are less than 50 grams per kilometre. Now, the allowance is 100% of the expenditure you incur in the year of purchase of the vehicle. In addition to that, the employee will have little or no taxable benefit. So let's move on to research and development. Expenditure on qualifying research and development can lead to tax advantages. The advantage obtained depends on whether the company is large or if it's an SME, that's a small or medium enterprise. Being a European initiative, the limits in assessing whether a company is large or small or medium size are stated in euros. If the company falls within these limits and is a SME, it can claim either an enhanced tax deduction of 130% of the qualifying costs, or it may claim an R&D expenditure credit. Whereas if the company is a large company, it can only claim the R&D expenditure credit. So you may wonder why we're talking about R&D when these reliefs have existed for a while. The answer is twofold. Firstly, to remind you of this valuable tax deduction that may be available if you invest in qualifying research and investment and development activity. And secondly, because from the 1st of April 2021, the cash repayment that SMEs may generate as a result of their R&D claim is going to be capped. Now, before I pass you over to Claire, there's one final corporate matter to discuss. Now, this is the new Free Ports initiative. The idea behind Free Ports is to level up areas within the UK. Presently, the government has only identified 8 free ports, and only one of these is in the Midlands. It's going to be near East Midlands Airport and actually situated by the East Midlands Parkway station. With free ports, there's 2 aspects to them. Firstly, businesses within the free port will be able to import and temporarily house goods without paying import duty and with reduced paperwork. Secondly, there will be tax sites within these pre-ports that allow companies to benefit from enhanced capital allowances, stamp duty relief, and business rates relief. So that's the end of the corporate specific measures. We've seen a welcome increase to loss relief to generate cash flow for some companies. For others who have spare cash, we've seen the opportunities to invest for their future and receive tax breaks. But for all companies, what we've got is 2 years' notice of the tax rate increase. I'll now pass you over to Claire, who's going to deal with matters that affect all types of business. Thank you all.
Thank you very much, Rebecca. So as Rebecca said, I'm going to go through now some of the measures that affect all businesses, whether that be companies, partnerships or sole traders. First of all, the welcome news that there will be a temporary extension to loss carryback relief. Typically at the moment, a business that does make any losses in a year can only carry those back to the previous 12 months. But there has been an extension to the relief that will allow businesses to carry back any losses that they've made during the COVID periods to the previous 3 years. So any business that has made a loss will be able to take advantage and set those losses against their previous year's trading profits in order to generate a refund of tax that will be payable back to them. So a welcome tax injection for some businesses that have struggled over the last couple of years. So this applies for companies with any company having an accounting period ending between the 1st of April 2020 and the 31st of March 2022, so covering right over that COVID period. And for sole traders, any losses falling in the year 2021, so this tax year, and 21-22, the tax year that starts in April. There is a maximum cap for the amount of losses that can be carried back, and that cap sits at £2 million for each of those periods. So quite a good size there for the majority of small and medium businesses. Moving on to the VAT changes that were announced. There was a welcome extension to the reduced rate of VAT that applies to the hospitality and tourism sectors. A reduction of 5% was introduced last year, and a lot of those businesses were forced to close, so haven't really been able to take advantage of that VAT reduction. So there's been an extension of that now until the 30th of September this year. After that point, there will be an interim increase to 12.5% that will take us right through until the 31st of March 2022, before returning back up to the main rate. So that's any businesses involved in hospitality, the provision of food and non-alcoholic beverages, holiday accommodation, and all of the events, museums, galleries, zoos, cinemas, etc. can all take advantage of that reduced VAT rate to charge customers. Other measures in VAT, there was a freeze on the registration and deregistration limits at the level that they are currently at, and also confirmation that the main rates and reduced rates of VAT will remain at 20% and 5% respectively. One thing just to note, a lot of people last year took advantage of the V80 deferral regime that was in place. So anybody who had a VAT quarter between March and June 2020 last year was able to defer their VAT quarter payments. Those payments come back round now and are due by the 31st of March 2021, except if you register to defer those payments a little bit longer. You are allowed, subject to registration, to defer them for a further 11 months, paying those by instalment. That process has to be done by the individual company or business, and the sooner you do that, the longer that deferral can spread through. So the deadline of that closes the 23rd of June this year. So please do sign up for that if you haven't already and you deferred your VAT payments this time last year. Moving on then to duties. Certainly a welcome a welcome piece of news for myself, freeze on alcohol duty. I know that's the one thing that's got a lot of us through the lockdown recently. So again, freeze on duty there, just to help to try and bring back some of that hospitality sector, help businesses that are looking to restart over the next few months, subject to the reopening and the lockdown being released. Also, a welcome news for all businesses, a freeze on fuel duty, which is the 11th year now that we've had a freeze on that particular duty. So again, like I say, welcome announcement for most businesses and individuals. If we move on now to look a little bit more about employers, and in particular the extension of the furlough arrangement, something that was leaked really before the budget, but confirmed again by the Chancellor, that the furlough arrangements many employers have relied upon will be extended until the 30th of September. There will be some changes to the scheme from the 1st of July. So until now, 80% of employees' wages have been covered by the scheme, but from July, the employer will be expected to contribute a little bit towards that. So a 10% contribution by employers from the 1st of July and a 20% contribution by employers for August and September. For those of you that are self-employed or know people that are, there was a very welcome change to the self-employment grants. The Chancellor last year was criticised heavily by those that had started out in self-employment for the first time in 1920. They didn't receive any grant at all. And that has now been recognised, and the fourth grant that has been introduced, covering the period from covering the period from February 2021 to April 2021, will now be available for anybody that filed a tax return for the 1920 year before the 2nd of March. So as long as you'd filed your tax return before the budget date. The grant's based on the same sort of principles as the previous three, but it will allow those newly self-employed individuals to make that claim for the first time, bringing in another 600,000 individuals into the income support scheme for the self-employed. There was a change announced by the Chancellor to the fifth grant. So there was a commitment that there would be a fifth grant, keeping the self-employed scheme in line with the employer's furlough scheme. But from the May to September period, the grant will be based now upon a turnover test. And if the self-employed business turnover has dropped by more than 30%, then the full grant will be available. If turnover has not dropped by 30%, then there's a much reduced level, and the maximum grant that can be claimed in that fifth period will be capped at just 2,850. For grants 1 to 4, that maximum level has been 7,500. So quite a reduction there on that fifth grant. The full details of how that's going to be worked out, what the definition of turnover is, all of that is yet to be released, but will be coming out over the next few months. The Chancellor confirmed some changes to national minimum wage, as you might expect, increased by 2.2% overall from April 2021. But one of the large changes was the difference in the national minimum wage and the national living wage. So previously, national living wage at a slightly higher rate was for anyone over the age of 25, but the Chancellor has now reduced that age to 23. So for a 23-year-old, they would be being paid £8.20 at the moment, and the increases will mean to them that they'll go up to a level of £8.91. So quite a big increase there. On the one hand, a little bit difficult for employers, but the good news was that the government announced a lot of help for apprenticeships. So to encourage businesses to take on younger people, there was a commitment to an additional £126 million for training for 16 to 24-year-olds in the 2021-22 academic year. All employers will receive a grant of £3,000 now per new hire between the 1st of April and the 30th of September this year. So quite a big increase, doubling the commitment that was made previously. And this is in addition to the existing £1,000 for apprentices in education, health and care. So on the one hand, an increase in minimum wage rates, but then a bit of a bonus for employees to keep taking on those new apprentices and supporting training within the UK. Moving on, I've got a bit of a roundup of some of the other issues. First of all, an extension to the working from home expenses. So last year was introduced the ability to refund any expenses that an employee had incurred to allow them to work from home if they were forced and required to do so. And that's been extended into next tax year. So if your employees have had to purchase computer equipment or desks or chairs to be able to work from home, there's a refund allowed to be made to them tax-free. Unfortunately, no extension to the claim that you can make for working from home. That was still left at the £6 a week. I know not a lot really to cover the expenses of working from home, but that was kept at the same level. We will see an increase in company car fuel and van benefits, and the van benefits themselves from April 2021. Those increases will all be in line with the Consumer Price Index, as previously mentioned in other budgets. That one was stuck to. The statutory sick pay and the enhancements to that will continue for the time being. So allowing employers to claim statutory sick pay from day one, where their employees are having to self-isolate due to the COVID-19 crisis. And the final welcome bit of news was with regards to enterprise management incentives. So a type of share option scheme that would normally apply to employees that work a set number of hours per week. So usually you would have to work at least 25 hours a week or at least 75% of your working time to be able to qualify. But it has been recognised by the government that many people have these schemes in place, and they have given a concession, appreciating the fact that people may not have been able to meet those qualifying times due to furlough or due to the closure of their employers. So some quite useful little bits and pieces there. Not mentioned in the budget directly, but as mentioned in previous years, the budget did confirm that the off-payroll working regime would be introduced from the 1st of April this year. Many thought there could have been a further delay to this, but there has been a commitment that this will now go ahead. So for those affected, the relationship and the responsibility for a deduction of PAYE and national insurance is moving from an individual's personal service company to the end client. So effectively what this means is before April, an individual could set up a personal service company and could then, the personal service company could then engage with the end client. It would be the personal service company's responsibility to judge whether the individual was deemed to be an employee. Many of you may have heard of IR35 legislation, and that all surrounds this particular area. So what's changing? From April this year in the private sector, already brought in the public sector, but now in the private sector, the end client will be responsible in making a decision as to whether the relationship is that of an employee or not, and it will be the end user that will be deducting the PAYE. And the reason this has been brought in is really to change the emphasis onto the end clients. The end clients are likely to be more wary of what they're doing. HMRC know that they're the types of businesses that they can query and challenge if they get it wrong. So it's all about switching that responsibility over. Now, it applies to medium and large size businesses. So anybody that meets 2 out of the 3 criteria, and those criteria being turnover of more than 10.2 million, a balance sheet gross value of more than 5.1 million, or more than 50 employees. So 2 out of those 3 means that you are medium or large. And if you are a medium or large size client, then you will be responsible for judging now this relationship you have with your contractors. Hot topic for many, many years, something that HMRC have been trying to drill down on. And this is their attempt now to do that, change that emphasis and to force responsibility onto that end client. So not only does it apply to companies and people that have and contract through a personal service company, but it also applies to self-employed consultants, and the same judgment will be required for any self-employed consultants that the end client uses. Moving on from that, the last topic that I want to just touch on is the plastic packaging tax. Now, this was introduced a couple of years back, the idea that the government needed to encourage more recycling, and there was further details announced in the budget this year. So the new tax will be introduced from April 2022, and the cost of it will be £200 per tonne on any plastic packaging with less than 30% recycled material. So again, it's a promotion and the use of alternative green or recycled packaging materials, and just trying to force businesses to think about their corporate responsibility. The way that this will work is that if you are caught by the tax, you'll be required to make quarterly tax returns and payments. But for some of the smallest businesses, there will be an exemption from this. So anyone that imports or manufactures less than 10 tonnes in a 12-month period will be exempt from these rules. So that's everything from me. I'll now pass you on to Ben just to go through some of the issues affecting individuals and changes to the tax administration.
Brilliant. Thank you very much, Claire. Good morning, everybody. As Claire alluded to in her introduction, there was a lot of speculation prior to the budget about what might be challenged, what might be changed when Rishi spoke on Wednesday. But I think from a personal tax perspective, private client perspective, the budget was more interesting by virtue of what wasn't actually there, what wasn't changed. So as you can see on this slide, we're expecting something to happen with capital gains tax. I know a lot of us in our profession have been very busy leading up to the budget, trying to get transactions through for our clients in anticipation of a capital gains tax change, either in terms of the rates or in terms of business asset disposal relief, formerly entrepreneurs relief, but they've both remained exactly the same as they were before. As you can see elsewhere on the slide, no changes to the inheritance tax regime. There was no change to the business property relief within that, very valuable relief for a lot of businesses. And there was a lot of speculation that there would be at least some form of tweak to that coming up. And there was also no mention of a wealth tax that had received quite a lot of press commentary and speculation following release of a few reports from Office of Tax Simplification. We do have tax day coming up on the 23rd of March. Probably of less interest to most people than those of us in the tax profession. But on that day, the Treasury are going to announce a number of consultations that should be impacting tax policy and tax administration, probably for at least the next decade or so. And I imagine that from that, we'll get an idea of how the Chancellor and how Treasury and HMRC are expecting to raise the funds to pay for all of the fantastic investment reliefs and coronavirus support they've been giving out over the last year and for the next year or so. Should we move on, Claire? Because we do know a few things from a personal tax perspective. So the personal tax, personal allowance rate is going to increase for the 21-22 tax year. It doesn't go up very much. Obviously, it increases by CPI, so we're moving to 12,570, and it will remain static at that point until the 5th of April 2026. That's going to be a recurring date for a lot of what I've got to say. The higher rate threshold increases up to 50,270. National insurance is linked to that. The other allowances and thresholds, capital gains tax, annual exempt amount remains static at this year's rate. So that's £12,300 for individuals, personal representatives for estates, and a few trusts, and half of that for the majority of trusts. And again, that remains the same until April 2026. The inheritance tax nil rate band and residence nil rate band remain static for another 5 years. And then we've also got on there that the investment levels for ISAs, junior ISAs, and child trust funds will remain at 20,000 for the normal ISA and 9,000 for what you can invest on behalf of your children. Thank you. Pensions, interesting topic. A lot of speculation again beforehand about what was going to happen for people's pensions, whether it be a change to your annual amount that you can invest or the lifetime limits. We have seen the income threshold increase up to £200,000 before the amount that you can contribute to a pension on an annual basis starts decreasing, which is good news for the majority of people in the country. It's not all good news, because the bottom limit, so the amount that your annual allowance can drop down to, is now decreased from £10,000 to £4,000 per year. And if you contribute over that amount, there is a tax charge. The lifetime limit has increased to £1,073,000, and that will remain frozen again till April 2026. I get the slight feeling that it's going to annoy quite a lot of IFAs who have gone from having very nice round numbers of 12,500, 50,000 and 1 million to play with to these slightly increased numbers, but that's okay. Stamp duty land tax, the holiday that had been in place has been extended for another 3 months. So previously we're expecting that if you hadn't managed to complete by the end of March, the stamp duty would revert back to its old levels, kicking in from £125,000 purchase price. But we've now got until the end of June if your purchase price is up to £500,000, and then for the 3 months after that it reduces down to £250,000 before stamp duty kicks in. There is a 3% surcharge for purchase of a property that isn't your only property or residential property, or if you're purchasing through a company, and there is a 2% surcharge on top of that that is introduced from April this year for non-residents who want to acquire property, residential property in England and Northern Ireland. Thank you. There was not very much in terms of changes for social tax reliefs, things like gift aid, etc., announced in the budget, but one thing that has been extended is social investment tax relief. I think this ties in with a lot of the other policies about how to encourage community investment and kind of getting money out to local authorities, local communities, so they can purchase assets of value or kind of businesses, local businesses, and keep them running. It was due, this tax relief in particular was due to close on the 6th of April 2021, so just another month or so away, but we've extended that for 2 more years. It's quite good. You get 30% back as income tax relief if you kind of have patient capital invested into qualifying community projects. So I think it is very valuable, and it's nice to see it extended. A few other measures that kind of link in with it being an investment budget, and tying in with the Conservative Party manifesto policies of trying to get down to carbon neutral and encourage a switch to a greener Britain. NSNI linked green saving products are going to be released. So we're going to have a gilt and a linked savings account at NS&I. The details are still to be published by the summer, but it should be quite interesting, and I think it's quite a good idea. And that somewhat links into the UK infrastructure bank that's going to be formed in Leeds. So this will be a bank that's given quite a lot of capital to encourage investment in infrastructure projects across I believe the whole of the UK, and kind of encourage more spending and building, I can't remember what his phrase is, building Britain back better again, something like that. Administrative matters for tax. So how HMRC are going to be approaching things. There's going to be a tweak to the penalty regime for both VAT returns and self-assessment tax returns to align the two administrations. So the penalties will be much more similar between the two. For self-assessment, it links in to the introduction of making tax digital for income tax, which we have seen for VAT previously, which is why there's a difference in the implementation dates. So VAT is going to kick in next year. For income tax, for certain individuals, those with unincorporated businesses or landlords with an income from those sources of over £10,000 from 6th of April 2023, and for everyone else everyone else within the self-assessment system from 6th of April 2024. It's moving to a points-based system. So once you've accrued a certain number of points because you've filed late or paid late a certain number of times, a penalty will be implemented. For those who file late, who reach a certain level of points that are going to be needed, it's all still to be confirmed, but the penalty will be £200 rather than the current £100. And as you can see on the slide, there is a change to the late payment regime that links into the amount of tax that hasn't been paid and the amount of time that is left outstanding. I think it's quite interesting. HMRC have promised a light touch approach to them in the first couple of years, and the fact that it's points based linked in with the introduction of making tax digital gives me a little bit of a pause and makes me think that HMRC aren't confident they're going to get the launch of making tax digital for income tax quite right straight away. So they're anticipating a lot of people not being able to file on time, which is why they might be willing to go a little bit softer. Thank you, Claire. And then in terms of HMRC going the other way and being a little bit harder, they've announced a £100 million investment into a task force of, as you can see there, 1,265 compliance officers who are going to be specifically focused on COVID-19 related support schemes. So the job retention scheme and the self-employed scheme, I think, are going to be the main focuses for those. That's a lot of compliance officers. I imagine the task force will be set up for at least a couple of years. So I'm anticipating a very high number of inquiries that will be coming out of that. HMRC have been active within their current sort of compliance structure, but having a dedicated team for it just shows how keen and willing they are to challenge people. They want to make sure that the general tax-paying population is protected from potential fraud. And I think that's probably me done. So I think we're going to hand back to Raj for question and answer session, please.
Thanks, Ben. And thanks to Rebecca and Claire for 3 fantastic presentations. Lots of detail in there. As Charles has said, if you've got any specific questions or any follow-ups, then we've shared the contact details. You can get in touch with the team as well, and they can pick those up. I'm just having a look to see if there's any initial questions which have come in. I don't think they have yet. So I've got a couple of questions to start with, if that's okay. So first of all, in relation to corporation tax, a couple of questions for me. I remember, obviously, during feels like a lifetime ago now, doesn't it? But during the Conservative Party leadership contest, I think it was Jeremy Hunt who said he wanted to drop corporation tax to 12% in order to turbocharge the recovery in the economy. I mean, obviously, we've seen corporation tax fall fairly steadily over the last 10 years. But from your feedback from your businesses, did that spur greater investment and growth within different businesses, would you say?
Yeah, shall I answer that one? So certainly from the clients we have, I think there's a lot of clients that have looked to invest in a corporate structure. A lot of businesses that were perhaps previously set up as sole trade or partnerships not only took some of the commercial advantages, but also the opportunity to incorporate, to take advantage of those lower tax rates. But I think over the course of time, there's been lots of talk about a system that's a little bit unfair, people that have been allowed to perhaps manipulate a lower level of salary and take dividends, which of course we all encourage that you do look at. So this is probably a little bit of an attempt to equalise that system, putting up the tax rates for companies. The one thing I would say though is even at the 25% rate, we would still be the lowest tax rate in the G7. So still very competitive compared to some of the big powerhouses in the modern world, even at that 25%.
Yeah, and I'm obviously conscious that we haven't seen corporation tax rises of this scale for a number of years, but in your experience, and it's again a question to the whole team, how do businesses generally tend to respond to corporation tax rises? Because some commentators have said, oh, it could lead to an impact on wage growth, it could impact investment plans. Is that something that you could foresee happening moving forward?
I think a lot of businesses look for savings. I think Rebecca mentioned a couple of those earlier. So there's definitely going to be a rise in businesses looking to make claims for research and development, for example, which is a really beneficial relief for anybody that is involved in developing products or processes or innovation. So a massive encouragement if you are in that field. And again, things like capital allowances. It's an opportunity for investing in plant and machinery, and the growth of businesses, and certainly our clients have taken opportunity in the past when these things have been introduced to really focus and look at those. So I think businesses just need to pay more attention, really, to take stock of where they are, to look out for what is available, and to get some advice on that and make sure they're claiming everything that they can do to get that rate down.
Yeah, that's a really interesting point. So we did some research a couple of years ago on R&D tax credits, and we found across our members that whilst there was a willingness to obviously use that or utilize that process, a lot of them weren't actually aware that they could claim them. So yeah, we tried to do a big piece of research on how we could raise awareness of R&D tax credits and how that could benefit businesses across the region, really. You mentioned there, Claire, obviously, and Rebecca, your presentation, which alluded to this, the support for the superannuation for those investing in plant and machinery. But am I right in thinking that there wasn't the equivalent support for those, for example, investing in digital technology? And is that something that you think the government will look to rectify in the next few years?
Yeah, you are correct. I mean, the super deduction was only for items that would qualify in your capital allowances main pool, which tends to be physical plant and machinery of some description. Occasionally some software products, but there's quite tight rules on that. I guess a lot of the digital products, perhaps the government are thinking maybe might fall under the R&D regime, particularly if it's something innovative and new. And obviously our R&D covers a range of industries right across the spectrum. It doesn't mean you have to be people in lab coats sat in a laboratory testing. It certainly does cover technological advancements in different digital software and IT. So I guess that's a little bit of a cover for those that are investing heavily in new digital. But I do think potentially, yes, I think that in the next budget, potentially that is something that the Chancellor will look at, particularly with the introduction of making tax digital. Obviously, there's a promotion of the government for everybody to become more digital. So you'd like to think that there would be some sort of incentive for businesses to adopt that technology.
Yeah, very much so. And I think one question I had as well You mentioned obviously the extension of the self-employment support scheme, the SEES scheme. But one thing that we've picked up from our members is the lack of support for those company directors or limited company directors. Was there anything in the budget that could point to that, or again, any kind of future changes you think might be coming along? So that's something that we picked up quite extensively. Feedback from those limited company directors just saying we're just not getting the support we need right now.
Yeah, it was one area that wasn't really addressed in the budget, unfortunately. We thought there would be something offered there, but other than the additional grants for certain industries, so the mention of non-essential retailers being able to claim up to £6,000 worth of grants, and the hospitality and tourism being able to claim up to £18,000 of grant. Other than that, as a bit of help for those businesses, there wasn't really any support as we'd have hoped for owner managers and directors. Really, no, there wasn't. No,
yeah, and I think that's something that's going to become more and more vociferous in terms of campaigning and pick up in the next few months, I'd say. Ben, you made some really interesting points around the green bond and the green recovery. And a few of the things that we've picked up around the government's intention to obviously drive net carbon zero targets. There seems to be a bit of a kind of contradiction between introducing these government green bonds, but also freezing fuel duty. I mean, do you think the changes that they've made and the policies they're implementing will help drive that move towards carbon neutrality?
You'd have to hope so, wouldn't you? I think an investment structure like the new bond, it's an innovative idea. I think the devil will be in the details for it in terms of what it's going to encourage in terms of actual green infrastructure investment, what's going to qualify, what the kind of the finances raised are actually put towards. I think the freezing fuel duties is kind of it's nice. It's good for all of us individually in terms of cash in our pockets and what we're doing as things stand right now. But I mean, I was reading something earlier today that said that we've seen a 50% increase in the number of electric vehicles on the road in the last year. And I think that's only going to continue, especially as we've got a lot of companies being encouraged to switch to electric fleets. And I think just having a dedicated green infrastructure bond from the summer will encourage that change in the future. I think it's a balancing act, isn't it, between what you can do right now to help people individually on their day-to-day lives and what you can do to really encourage that coming up in the next few months. But like I say, it'd be interesting to see what the actual details are come June.
Yeah, no, very much so, particularly where we've got COP26 around the corner as well. Well, I think, we don't seem to have any initial questions. I mean, I guess my final questions to yourselves before we wrap up, and this is for each of you really, is, I mean, what advice would you give to businesses to prepare for these changes? Is there anything specific you think they need to be doing before these changes go live? And again, happy to throw it out to the wider panel.
I would say one thing we always try and encourage people to do is, before you're making any major financial commitment, speak to your advisor, because often in the legislation that gives a relief, there's particular rules that have to be followed, and people are often caught out if they just go ahead and invest without advice. So these reliefs are very valuable. You want to get it right, is my message.
Thanks, Rebecca. Claire or Ben, anything to add on that note?
Yeah, I think for me, just going back to a little bit we touched on earlier, talk about what's available for your business. As you mentioned, Raj, there's a lot of businesses out there that don't take advantage of some of the reliefs that they are entitled to. They just don't realise that they might qualify for them. So really just having a chat with your advisor making sure you're in regular contact. We like to speak to our clients as often as possible just to find out what they're up to, because there's certain things that you may be doing that would fit into a category you might not expect, like the R&D, like some of the capital expenditure that you may not have realised you would qualify for some of these advantageous reliefs. So really, it's all about now trying to maximise everything that you could possibly claim to set off against your profits going forward.
Yeah, particularly as we don't know how we will emerge from this crisis. I mean, I think there's a lot of, one thing that concerned us was there was a lot of assumption from these plans around consumer spending levels going back to normal in the next few months. And I guess as we saw this time last year, when we had to eat out to help out, if the economic and epistemological arguments aren't aligned, then people will be worried about leaving the house and kind of using these services and things like that again. So yeah, that is a really interesting point moving forward. And I mean, Ben, any final thoughts from your side?
Not too many. I think we've covered everything that was intended. Claire and Rebecca have answered that last question very well. I guess just one piece of free advice for people is, if you're going to be buying lots of plant and machinery and you're planning it now, maybe hold on for another 3.5 weeks. So looks like you'll get into the super deduction bit. One bit of nice free advice, hopefully.
Oh, very much so. Thank you for that. So yeah, look, I'm conscious, obviously, we're coming up to 10 o'clock. All that remains for me to say is, look, thank you so much to our panelists for 3 really informative and really helpful presentations. Again, thank you to all of the participants who joined us for today's session. If you've got any follow-up questions, then please do liaise with the guys. I think they've got the contact details in the chat box. Again, from a chamber perspective, if there's anything else that you need clarifying on, or any additional points that don't make it, that you need further details on, again, we're here to help. Please do have a look at the events section of our website as well for similar events coming up that might be of interest. And of course, if there's any questions that you have, please do feel to get in touch with either myself, Charles, or Grace. And all that's left me to say is thank you very much. Thanks for joining us, and hopefully see you again soon.